The People's Bank of China just confirmed 16 consecutive months of gold purchases. Not 15, 16. And buried 3 paragraphs below that headline in the same data release is the silver signal that nobody in Western financial media is connecting. I'm Marcus Caldwell, independent market analyst. I've been tracking these 2 data streams in parallel since November. Today they landed in the same news cycle simultaneously. That convergence is what this video is about. China's gold reserve stood at 74.22 million ounces at the end of February, up from 74.19 million ounces at the end of January. 16 unbroken months of sovereign accumulation that did not pause when gold hit $5,000. Did not pause when gold hit $5,200. Did not pause during the January crash that sent silver from $121 to $79 and wiped $1 trillion from the precious metals market in 60 minutes. This is not a routine central bank filing. This is price-insensitive sovereign accumulation, with a strategic doctrine behind it. Before I reveal the next critical data point, if this intelligence is valuable to you, hit that subscribe button and turn on notifications. The equity edge exists to give you the market intelligence that institutional desks track, but retail investors rarely see. Independent analysis, no products, no signals, just the data. Now let's get into what the smart money is actually doing. The doctrine behind 16 months. In February 2022, the United States government froze $300 billion of Russian central bank reserves held in Western custodial systems in 48 hours without judicial review. Every central bank holding assets in Western custody received the most consequential lesson in counterparty risk that sovereign finance has ever produced. China holds $3.4 trillion in foreign exchange reserves. At its February level, gold represents 9.6% of those reserves. The global central bank average is 15%. The United States holds 67% of its reserves in gold. China's gold allocation has room to more than double before reaching the global average. And it has been accumulating every single month for 16 consecutive months to close that gap. The strategic doctrine is 6 words. No counterparty risk, no sanctions vulnerability. Those 6 words explain 16 months of purchases at whatever price gold was trading. And they apply with identical force to physical silver. The bar in the vault with no paper claim attached, no custodian that can be sanctioned, no exchange that can cash settle it away, carries exactly the same strategic characteristic. The silver dimension nobody is reporting. While China was buying gold for 16 straight months, it was simultaneously restructuring its silver position in a way that mirrors its rare earth strategy almost exactly. As of 2024, China held approximately 70,000 metric tons of silver reserves, with strategic purchases of unrefined silver concentrate continuing into 2026. On January 1, 2026, China activated a 44-entity silver export licensing system, reducing the companies permitted to export refined silver from hundreds to 44. China controls 2/3 of the world's fresh silver bar refining capacity. It just created a regulatory choke point on that infrastructure while simultaneously accumulating the upstream raw material. The rare earth precedent is the most important template here. China established refining dominance, then progressively tightened export controls during geopolitical tension. The result was supply disruptions, price spikes, and a decade-long Western scramble to build alternative supply chains that still have not fully replaced Chinese processing capacity. The silver playbook is structurally identical. Refining dominance established, export licensing tightened, upstream concentrate accumulation accelerated. Western COMEX vault draining simultaneously. The COMEX drain, reading in the same session. Here's what the COMEX data shows right now, read against the PBOC confirmation published today. Registered silver declined 20.7% in the past 30 days. 21.3 million ounces withdrawn in a single month. The coverage ratio stands at 14.4%, below the 15% threshold. The COMEX stress index classifies as active stress territory. Paper leverage is at 6.9 times, nearly 7 paper claims for every 1 physical ounce of deliverable silver. At the current withdrawal pace, registered silver would be exhausted in approximately 80 trading days. COMEX registered inventory ran at 240 million ounces in April 2020. It sits at 86 million ounces today, a 64.1% decline. Shanghai inventory fell from 559 tons in November 2025 to 318.5 tons in February 2026, a 43% decline. But here's the data point that separates the current cycle from every prior delivery stress event. In normal delivery stress, metal moves from registered to eligible, changing classification but remaining in the system. Today, the metal is leaving the vault entirely, into private custody, into industrial facilities, into allocated accounts at bullion banks outside COMEX-approved warehouses, into ownership structures where exchange rule changes, margin hikes, and cash settlement mechanisms cannot reach it. 820 million ounces of cumulative 6-year deficit. 80.4% of that absorbed by irreversible industrial consumption. Solar panels generating electricity on rooftops across China and India right now. EV components charging in garages across Europe right now. AI data center infrastructure processing queries right now. Silver consumed industrially does not come back. It has gone at the molecular level, dispersed in concentrations too dilute to economically recover. The ratio compression signal. The gold-silver ratio currently runs above 60. The 30-year average is 60 to 1. At the historical ratio, every 1 ton of gold demand equivalent carries a 60-ton silver demand parallel. The structural force driving gold higher through sovereign accumulation creates a ratio compression impulse that pulls silver faster and harder than gold when it activates. Because silver's market is 60 times smaller, and its physical supply is 64% depleted from its 2020 COMEX peak. The dollar share of global foreign exchange reserves has fallen to 56%, its lowest level in 3 decades. Central bank gold demand reached 863 tons in 2025, with a 6% acceleration into year-end. Every variable driving sovereign gold accumulation is intensifying, not stabilizing. The honest counterargument. China added only 30,000 troy ounces in February. At $5,000 per ounce, that represents approximately $150 million. Less than 0.01% of China's total foreign exchange reserves in a single month. The PBOC is accumulating at a pace that is strategically meaningful in its consistency, but is not moving the market by raw volume alone. Multiple institutional analysts consider it plausible that China's actual gold holdings are 2 to 3 times the officially reported figure, accumulated through channels outside the monthly SAFE report. If accurate, the 16-month streak is not the accumulation story. It is the disclosure strategy. The real accumulation may have already occurred through mechanisms that don't appear in the headline data. On the silver side, the exchange has never formally defaulted. Every prior delivery stress cycle resolved through EFP arrangements, eligible conversion, and margin escalation. The toolbox exists, whether it is sufficient for a vault at 64% depletion, with paper leverage at 6.9 times, is the question the current data cycle is answering in real time. 6 signals to watch this week. Watch the PBOC March. Data publication at safe.gov.cn on the 7th of the month. Whether 16 months becomes 17 without a gap is the primary sovereign accumulation signal. Watch COMEX registered inventory daily at cmegroup.com. Acceleration of the drain rate through the March delivery window is the critical stress variable. Watch the gold-silver ratio. Compression below 55 historically precedes silver's most violent outperformance phases relative to gold. Watch China's 44 entity export data for evidence. The licensing restriction is producing the supply reduction its structure implies. Watch the Shanghai silver premium relative to Western paper. The current 12 to 13% gap documents physical scarcity in real time. Watch gold's $5,000 psychological level. Silver's $95 thesis requires gold above 5,000 as a prerequisite condition. At 3 p.m. today, China confirmed 16 months of gold buying without missing a single month. While the COMEX silver vault drained at 785,000 ounces per day. Both data points landed in the same news cycle. Both point at the same destination. Silver is trading at $83, below JP Morgan's own published $81 full-year average, and below the institutional consensus range of 85 to 95 for the second half of 2026. The map is in your hands. Write sovereign in the comments if you're tracking both data streams. The equity edge, independent analysis, no products and no signals. Just the data.